Hello and welcome to Property Information Evening. My name is Slesh Chen. I'm a chartered accountant in public practice, and today we'll be talking for about 1.5 to 2 hours, depending on the feedback we get from you guys. Format of the day, so it's pretty casual. If you have any questions, just type in your questions and we'll try and answer them as we go, or we'll try and answer them at the end. Also, we'll hang around for about 15 minutes at the end of the presentation to answer any questions for you. We'll also run live examples of the investing strategies that we follow as investors at the moment. What are we doing? What we're seeing out there, what people are doing to invest in properties and to make money. We'll show you examples of that. And also we'll try our best to make the next 1.5 to 2 hours exciting for you. So just a quick background on myself, who I am. So I was just saying I'm a chartered accountant in public practice. I'm also a property investor, active property investor. I buy and hold properties. I do cash flow investing, and I do land banking assets as well. I also invest in trading activities where you buy, do up, and sell houses. So those are some of the things that I do in terms of property. I'm a partner here at GRA. I've been a partner here since 2012. I have 16 years experience in accounting and property investing. And currently in my whole portfolio, we have over 51 whole properties. So these are basically hold assets which are generating cash flow positive returns, and also we've got massive land at the bank. So basically, they're properties with big land. If we subdivided this property, we'll end up with circa 300 sections. So, but we're not going to do that yet. We've just rented this property out for cash flow purposes. All our houses are rented to social housing providers. We've been renting all our stock to social housing providers for the last 14 years. So it wasn't because of tax we went to social housing providers. We were already doing that. Now, before I go any further, I just want to make it clear to everyone, I'm a chartered accountant in public practice. So I don't have any financial, I'm not a FMA. So I just want to make sure everyone reads that disclaimer. I'll give you about 10 seconds to read that. And if you have any questions about this particular disclaimer, please email us and we'll answer questions for you. So a little bit of background about who GRA is and what do we do and all of that. In case you don't know. So we are a chartered accounting firm here in Newmarket. We provide our clients with normal accounting work, so your business accounting, compliance work, any bookkeeping. We also do asset protection. So basically, we look at protecting your family home. If you're a business owner, we look at protecting you, how we're going to protect your businesses as well from creditors. Now, I'll tell you this. You know, people work all their life to set up their business, their family homes, or their investments, right? It doesn't take much to do asset protection to protect your portfolio. It's not expensive. It's really cheap to do it. And once you do it, it's protected for life. And probably every 5 or 10 years, you do a little check, make sure everything's up to speed. We also do insolvency advice. So if you are not in a position to pay your creditors, so we can help you negotiate that. If you've got issues with the IID, we are more than happy to help you with that and help solve your problem. Or you're defaulting to the bank, we can negotiate with the banks and help you out of that tight spot as well. We also give you tax advice and tax planning. So this is where we look at your current affairs and we look at ways that we can minimize your tax, and we come up with different options. We also incorporate trust. So if you don't have a trust, so we use a family trust to put your family home in a trust. We use a business trust to hold your business, and we also provide professional trustee services. So I'm a professional trustee. We provide the professional trustee services. So basically, for mum and dads who have kids would like a professional trustee, we come on your trust or your business trust to ensure your kids are protected in the event something happens to you. And touch wood, nothing happens. When one of our biggest skills is property investment and education. So we have property school and we have property development school as well. And I'm going to talk about this further as we go. Now, if you do need any sort of information from GRA, whatever, you can follow that link at the bottom there and send us a request for information, or you can contact Amy. Amy would have been the one who would have been sending you details about this presentation today. Also joining me today is Maggie and Then. So Maggie and Then are really good friends of mine. We've been friends for over 10 years now, and trust me, guys, they're very smart people. I use Maggie and Then every day. I call and abuse them as much as I can. And so feel free when they're talking to flick your questions through or right at the end ask us questions. But they are smart property investors. They understand property sites. They understand what needs to what needs to be done on the site. Both Maggie and Then are developers as well. Then's been trained how to become a developer, and he's really good at it. And he's running a lot of projects. He'll show you examples of that as well. And Maggie's got some amazing stories to tell about certain things that she's been up to. Just a quick market update, what's happening out there, and what we're seeing out there. There's you read the media, there's all this discount properties available, all these investors in trouble. To be honest, we are looking for discounted properties. Then and I and Maggie are out looking at auctions every day. We can't find discounted properties. When I said discounted, like, if someone's saying a property was worth 1.5 million, now they're selling for 750, it's not happening. Very, very hard to find them. But what you have happening in the market is, yes, you can find properties at a discounted price, not heavily discounted, but at a good discount price. So if you ask me when's a good time to buy, it's probably the good time to buy is now. And the other thing that we're seeing in the market is rent is going through the roof. So because there's a shortage of supply, rent is going up. So it's still basically it's still a good time to look for opportunities and buy them. Then would tell you, like, we put offers out every day. We go to auctions every day. Today we tried to buy 4 units in Rotorua. So we put an offer to buy 4. So we're putting out offers all the time. I'm currently negotiating 24 social housing for the government. So I'm negotiating that at the moment. And if I can pick the contract up, I'll buy 24 more houses. Interest rates, we believe, has passed the peak. So we believe the interest rates are going to go down. Probably in the next 6 to 12 months, we'll see interest rates going down. We can't see interest rates going up anymore. It's done what it's supposed to. So, you had the Reserve Bank increase the interest rates to control inflation, and they've managed to do that very successfully. Like I mentioned earlier, there's a strong demand for housing at the moment. So you've got strong tenant demand and social housing demands as well. And part of the reason there's massive demand for social housing is because the national government has come in and stopped motels. So basically, they don't want people staying in motels. They want people living in housing at the moment. So the government's out there signing as many houses as they can so they can move families from 1 bedroom, family of 3 or 4, from 1 bedroom into a 3-bedroom house, which is fantastic news. If you've got a family, you can't live in a motel for the rest of your life. You need to live in a house, and that creates a good family, and obviously gives kids opportunities to grow up in a good home. There's huge shortage of properties in Auckland at the moment. Massive shortage of rental properties, and to be honest, I think it's just not Auckland; it's throughout the country. I get calls every day from out of Auckland, see if I'd be ready to buy properties in their towns because they just can't find rental properties. In Auckland, when you have a property come up available for rent, we have about 100 to 150 families show up to look at properties. So there is a massive shortage. And part of the reason is, there's a lot of people have been moving into the country. So demand versus supply, that's in favor of investors. So if as investors, you own properties, you can increase your rent because the demand is so high. And to be honest, as investors, you should be increasing your rent because your cost of money is up 300% or nearly, 200 to 300%. So why wouldn't you? For example, we do development and I can borrow 9.5 to 10% with first-tier lenders, but most people are using second-tier lenders and they're borrowing 15 to 17%. So when you build these houses and they become available to be rented, the cost of this building is so high. That's why rent is only going to go up now as well. What we're also seeing is there's favorable tax and tenancy changes. So basically now you can claim interest, which is fantastic, 80% from 1st April 2024. And so which is fantastic. And then from 1st April 2025, you get 100% deductibility on your interest. And also there's tenancy changes as well, where the landlords have more control of their property, which is really important. It's quite sad that Labor came in and changed all the rules where the landlords don't have control of their properties, but the landlords have more control of their houses at the moment. And what I want to show you now is some of the latest deals that we've done. And so Then is the one who's managing this with us, but I'll just go through this properties with you. So this is our Auckland trade. We batches in 2023, November. We've just finished renovating to sell. It's a cross lease property. We paid 526. We said it's crossless, but it's actually freehold. We just found out yesterday this is a freehold property. The renovation cost has been 175. So with interest and agents fee and everything at the moment, we're looking at probably around 780,000 is our total cost. The market value is between 875 to 900 grand. So our pre-tax profit is between 100 and 121,000. Now we like making this kind of profits, even though you can say the numbers are not big. But what it does is, allows you to build your capital, go to the next deal and the next deal and the next deal. So since we bought this property in November 2023, we haven't been able to find another trade. It's just impossible to find another trade. So this is one of the trades so we're working on. And you can look at the inside, what it was like when Then bought it. And then this is the work that we're doing on the property. And now this is what the property looks like. I mean, this is after renovation. So you can see we've double glazed it. We've built beautiful deck in front, beautiful fans. We've provided more car parking and all of that. So this is the inside now. You can look at the kitchen. And honestly, like it cost about 175 to transform a 3-bedroom house, but you add another 30, 40 years to these properties. And this is what first-time buyers are looking at. They want to buy a stock that all the work is done. They just move in and enjoy the property. So you can see, all double glazed as well. So, windows are not expensive. A lot of people say to me, windows are quite expensive to change. It was about 12 grand plus about 5 grand to install them. So 17 grand and you got all double glazed windows. And this is the toilet and bathroom. To be honest, Then he's done all the job here. He's managed all the tradies and everything, and he's done an amazing job of it. So this is another property we bought in November 2023 as well. We paid $1.3 million. And this is a property at the back here. So there's a house on the left, there's a house on the right, and there's a double garage. It's number 537, so you can see it. Our renovation cost was about 20 grand. So our total cost came to 1.32 million. So it's 2 dwellings we can subdivide. Now, if you look on the right, you can see our neighbors have subdivided and they've finished building. So on 2,000 square meters, they've got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. They built 10 houses on 2,000 square meters. We bought 1,100 square meters, something like that, with 2 dwellings on it. So it's a social housing list. So this was specifically bought for disability tenants, and we get 2,500 per week rent. So that's what we're getting at the moment. And with all our investments, we pay our mortgage on principal and interest payments. It's very important. We like to lower our debt level down as fast as we can. Now, this is another development site we're working on at the moment in Mount Roskill. We're building 3 high-end houses. This is a really good street, and what Then and I normally refer to as the Indian and Chinese street. So where they love beautiful homes next to a good school and all of that. So it's land and subdivision we're doing at the moment on this side here, and it costs us 1.8 million to buy the land. The building cost is $2 million, so our total cost is 3.8 million, and we should be done in 5 months. The frames have just gone up, so we should be done in 5 months. Our market value is 4.8 to 5 million. Our pre-tax profit is $1 to $1.2 million. So that's what our pre-tax profit is once the properties are finished building. Now, that's on the minimum side. We think we'll probably get more for these properties because they're high-end properties, they're big houses, and normally this is the stuff that's actually not built in Auckland anymore. So this is a very rare stock we're bringing to the market. Normally on a site like this, people build 8 to 10 houses. So why property? Why do we invest in properties? Why are we here? Why you're listening to me and all of this, So what is it that why is it that I want to get into properties, So the reason I believe we are here is because we want financial freedom. We want to retire happily and not depend on our jobs, We want to ensure we live off our passive income, and that's quite important because when you have passive income, you automatically get money in your bank account every day. Like with our portfolio, we'll show you the size of our portfolio later. We get about $7,000 a day in rent coming into a bank account every day. So cash flow is never an issue because you get 7,000 deposited into a bank account every single day. That's what we collect in rent. And that's 7,000 a day, not a week, a day. And then what happens is when you build yourself a portfolio, you can spend more time with your family and friends. And let me know if this is not your intention, if you're not listening for that purposes. I can tell you this now. So I'm 40 years old now. When I was 30, I basically retired. I've made enough money in properties. and all of that. And I could have gone into retirement, but I didn't want to. I wanted to keep growing myself, which I'm glad I did. And now I've got a portfolio that's growing bigger and bigger. The only reason I go to work, and I always say this to everyone, everyone goes, Slish, why don't you retire? Is because I'm bloody bored if I stay at home. I love waking up, getting dressed, doing my workout, talking to my mates on the way to work, making decisions, coming to work, seeing all my mates, seeing my clients who become my mates, and I love working with them. So most of my clients have been with me for the last 17 to 18 years. We've been together with clients, and all my clients are literally property investors. Either they are business people who invest in properties, or their mum and dad on income and they buy properties in investment. So 95% of my client base are multimillionaires because they started properties years ago. You know how people look at you and go, I wish I did this 10 years ago? Well, we did this 10, 15 years ago. So it's never too late to get into properties. You just got to get in there. And this is some of the questions we ask you. How long before you retire? You know, you could be a 40-year-old, you could be a 50-year-old, you could be a 25-year-old. Like you only need to invest properly for 7 to 10 years, and you have an amazing investment that can actually retain you passive income. That's what we do. And I'll show you how I've built my portfolio. Within 7 years, it started retaining me passive incomes. So what assets do you have? Some of you might have enough assets, so we might have to just reject a couple of your investments, or some of you might have, some of you might not have enough assets and you're looking at growing your portfolio. What debt level do you have? Is your debt level too high? So we'll probably get you to reduce your debt level down. So this is some of the questions we get you to, we ask you to start thinking about property investing. And do you have enough? Maybe you do have enough properties, or do you have enough equity? Maybe it is that you're living in a $10 million home. You can sell down, live in a $3 million home, and use the $7 million to invest. Some of those things, so, maybe you do have enough. It's just a matter of thinking and working out. And maybe some people have good cash flow and they just haven't been out investing. So those are the questions that are designed to think about what you're after. Now, here's an example of a person, say he's 45 years old, can they save for retirement? So their target is to save $2 million in savings. So that they've got 20 years to save. So you need to save 100 grand each every year, right? So for the next 20 years, right, you're gonna save 100 grand a year, which means you're gonna end up with $2 million in your bank account when you turn 65 years old. Now, you would need to earn $250,000 a year if you were to save 100 grand a year. So let's say your salary is $250, your PAYE is $74,000, your living expenses is $76,000, your savings is 100 grand. Now, I can tell you this now, anyone that earns 250,000 spends 250,000 a year. They'll pay their tax 74 and they'll spend the rest of the money on their lifestyle because they just can't save. I've noticed people just can't save. The more they earn, the more they spend because they improve their lifestyle. They go for the next thing that's up there. They start focusing on that. Now, property investment, if you do it properly, right? If you do it properly and you've done it correctly, you can make money. And you can make money really quick. The first one and the most easiest way to make money out of properties is buying it for less than the market value. This is how I got into property investing 14 years ago. I started buying properties for less than market value. So I would drive around the streets. I would look for private sales. I'd buy a property that for 320,000, the market value would be 400. So that's how I made my equity. That's how I kept buying. So you do 10 of those in a year, you made 800 grand. So imagine 14 years ago when I was making that kind of money, it would help me grow. And if you're keeping it for long term for capital gain as well. So when you keep properties for long term, so when I say long term, 7 to 10 years, you get good capital gain out of property investing. And like I said, it only takes good 7 to 10 years to create a good portfolio with a passive return. Also, when you with properties, you do renting or leasing for rental income. So you've got rental income coming, And one of the properties that I really enjoy is basically properties with 2 or 3 houses on it, because you literally get 3 times more rent. So, or 2 units, you got 2 rental roll coming through, and those properties are the ones I chase. And I'm going to show you examples of what I chase. Also, when you do improvements, repairs, or renovation to the building, you add value. So you instantly add value, which adds to your equity level as well. So this is why when you do property investing properly, you can actually grow your wealth and you can grow it really fast. So you've got two types of investing. You've got passive investing and active investing, right? So now you go, well, what is passive investing? All right, passive investing is basically buying the right kind of properties, and you're buying the right kind of investment properties. You got cash flow return coming through. You're banking on the land. You got capital gains coming through on this kind of properties. Those are your right kind of properties you buy. And when you have enough of these properties, you don't need to work anymore. Then one of the old tricks in the book was you buy 10 properties in year one, in year 10, you sell 5 and you hold on to 5 because you become debt free. So most of my clients have done that. They bought 5 or they bought 10 properties and they waited, 10 or 12 years and they've sold things down. And when you have enough, you don't need to work. And you can do this within 7 to 10 years if you invest correctly. And trust me, guys, if you're listening to me today, you'll listen to this conversation 10 years later and go, I wish I did that 10 years ago. It just doesn't get any cheaper, right? And then Maggie will tell you, we build houses and it's not cheap to build houses. It is quite expensive. Also with long-term quality investment, that leads to wealth, and intergenerational wealth as well. So your wealth grows. So when we say long-term quality investment, we're referring to cash flow positive properties. We're referring to properties with double income. We're referring to properties with big land. You can put more dwellings on later. That's what we refer to long-term quality investments, and creates intergenerational wealth. So you can give wealth, obviously, to your kids to help them into houses, or you can give wealth to your grandkids as well. So you can pass wealth down. Now, here's an example of a property that's got passive income. It's an Adele Place in Weymouth. So we bought this property for $707,000. We spent $40,000 on renovation. Our settlement cost was about $2,000, so our total cost came to $749,000. Our projected market value at the time when we did this about 4 years ago came back at $1.1 million. So instantly we made $351,000 equity. That's a 32% return on our money instantly, right? You don't get this kind of return anywhere. Like it's seriously some good return. So what we did was we raised the money and we bought 4 more houses at that time. So that's what the beauty of doing investing like this. And you can see it. We put 707,000. We put some money in. We borrowed some money. Market value was 1.1. We got 351,000. We got all our money out, and we took the money to buy more properties. And then this is our passive return. Currently, it's rented for $57,000 a year. Our insurance rates and repairs and maintenance is about $7,500. Our net yield is $50,000. And once we deduct our interest, say at 100%, because we've got this fixed at 5 years, our interest is $18,000. So we're banking $32,000 a year. Far as I know, this property is actually 70% geared. So we're actually banking $37,000 a year. Now, what we're doing with this $37,000, we're just paying off the debt as fast as we can. We're lowering our debt. Now, a lot of people go to me, do you go on interest only, or do you go on principal and interest payment? Now, principal and interest payment is referred to P&I. Now, we do have all our investments on P&I. I like to reduce the bank debt down. If there's funds available, I like to reduce the bank debt level down as fast as I can. Now, active investment is basically where you buy properties, you renovate, and you sell them for profit. Example of that property was the New Lynn property we were showing you that and we are doing at the moment. We bought it, we've done it up, it's on the market for sale. We've fixed houses with issues, so if there's unconsented work, we go in there and we fix all the unconsented work. We also do reclaimed leaky houses. Now, be careful if you're doing leaky houses. You need to be, the problem is you can't get bank funding. So make sure you get bank approval before you buy any leaky houses. Also, if houses are on flood zone, you need bank's approval before you buy them. We also rebuild rundown houses. So basically, this is where we demolish, build new houses. You can see the ones we're doing in Mount Roskill. And profits from our active investing basically goes back into our investing portfolio, either to buy and hold, or more equity released to us to buy more trades or more sites so we can demolish and build new houses. Now, I've got Then coming on now. So Then's been waiting there to come on. Now, Then is like I said, is a very informative guy. He's a property coach, and he's also an active property investor. So feel free to abuse him. And guys, before I pass this on to Then, I just want to make it clear that I'm $550 an hour. Then is $250 an hour. We got Maggie coming on 250. So you got $1,000 an hour of free resources today. So feel free to write your questions and we'll try and answer them as we go. I'll let you I'll let Then take over now.
Thanks, Alish. Good afternoon, everyone, or good evening. So, thanks for the introduction. So, Than Thunder. So, I'm an active investor, always on the market looking for a great deal, along with, in the office, assisting clients with, their investment strategies, whether they're looking to buy the next property that fit their criteria, or going through the due diligence to help them, identify that if that property is the right deal. Also, a lot of clients that I work with, they have a property that they own that they're looking to extract the most value out of it. And, going through a simple renovation can actually uplift the value of your existing portfolio. And, those are the things that I do in the office, along with, assessment and helping people that go, hey, I'm looking at this. What do you think? Or does it look like a deal? I said, yeah, get under contract through due diligence. But most importantly, what property has led me to is a career where, I'm looking at properties day in, day out. And that all started from, attending a seminar like this, along with going into coaching and, having the confidence and the knowledge and a safety network that allows me to go and take action. And it all started with trading. I didn't buy my first home. The first deal that I bought was actually a property that I bought to renovate, to add value, and then sold it for a profit. And that's how my journey began through property. But I'll share about those in more details. But just talking about active trading or flipping property, I want to show you another example of one thing that we've done some time ago. And this is in Goodwin Heights in South Auckland. Let's get the slide going. So you can see this is the property before and after photos. On the left, you see the before, on the right, the after. It had a full renovation done, new kitchen, new bathroom, new paint, new carpet, the whole works. And the key is, as Alish said earlier, is, buying right. You're looking for those deals, you're making your numbers, you do your numbers beforehand and making sure that everything is, or your due diligence is done thoroughly before you go unconditional on a property. And that's what we did in this one. We identified what we could do. So it was actually a 2-bedroom house. We could convert it into a 4-bedroom, a large floor area, and uplift the value, because obviously it is also outdated. So we knew what we wanted to execute, worked on the cost, and then went and bought the property with the intention of renovating it, selling it for a profit. So if you're looking at the margins on this deal, we picked this up for 824,500. The renovation cost, you can see, is under 100,000. The marketing fee, or the agent's fee, is what we refer to here, is about 31,000. And even future slides, you'll see that it refers to the agent's fee. The transactional settlement cost and interest for a period of 4 months, all up, it cost us 975,616, including the purchase price. So we sold it for 1.170 once the renovation is done. Cost us 975. That's a profit before GST and tax of 194,000 in the space of 4 months. Take GST out, we make 167,000, or just over that. So those are the deals that we go for. And it's not like I woke up the next day, found these deals. I mean, the effort, the hard work, seeing 100 properties before this, putting offers, getting rejected, and then going back and renegotiation. But these are the days of a property investor, property trader, just getting rejected and going back again, and identifying and sticking to your numbers, which is most important. Another example is, and you can find this in the current market as well, is dual income properties. So what I mean by that is that these two properties on a home and income, so it sits in one title. So you got the front house and the back house; they're all under one title. So simply, what we've done in this instance is actually separated the title into two, so that each could be sold separately. So the front was a 4-bedroom house, the back was a 3-bedroom house. It wasn't a reasonable condition. Could do with some value added, but we decided not to go through and do the full renovation, because we know that we could extract most of the value by just subdividing it and selling it as it is. So the numbers here is we bought it for 1.370. The renovation or the subdivision cost was about $50,000 just to get it into two separate titles. One we sold privately, the other one we sold through an agent. Interest rate, So it was a settlement cost, transactional cost for a period of 6 months. It cost us a total of 1.495. We sold a combined sale price of 1.81, so profit before GST and tax of 314,000. Take GST out, that's 267,000. So the reason why I'm showing you these is that the numbers like this are real, they are achievable, because when I started, I needed to know that there's someone out there that actually doing it and could share with me, and then said, okay, if someone else is doing it, why can't I do it? I just need to know how to do it. And that was my philosophy when I got into property. So how did I get ahead? My journey started back in 2015. So I was a sales rep working in the freight industry. So, my job was, looking after customers, bringing in new business for the company. And I enjoyed it, the hustle, the negotiations, and, getting clients on board. And for me, it was like, okay, this is me. I'm going to work through my way up through the senior management team, and, that's my future. But then something got me thinking. I don't know what it was at that time, and it said, like, people can be replaced. Something could happen to me, and then what? I've got nothing. I've got nothing next to my name, and so I just need to know what else is there. So that got me interested in, what is or what ways are people making money or setting up their future in New Zealand. And property is something that's common, a denominator that just keep up coming forward. But I had no clue. I had nothing. I haven't even seen a sales and purchase agreement. So I going, okay, I don't know anything. So went to webinar, went to one, the next one. Looking back, I should have actioned it a lot sooner than 2015, but I'm glad I did it. But at that time, I had access to saving about $50,000 and access to 130K of a revolving credit facility from family. So that was my starting point. I was fortunate to have that access to that money. So went and signed up to a mentoring program and did my first deal. And the thing is, it's always great to see the deals and see the money on a screen, but to have it sit in your bank account is the real enjoyment and going, actually, this is a deal. I mean, at first you see the money go out of your bank account because you're paying a deposit for a purchase and you're going, oh my God, this better work. But when you go through the whole transaction, your first deal and have the money land in your bank account and you go, okay, it does work. Yes, you've seen it, but now it's in my bank account. And for me, it was like, okay, I just need to get better at this. I need to do more of this. So while working full time the next following year, I put myself a goal of say one a quarter. And I said, I'm going to do one deal a quarter and then for a year. And I'd achieved that. And that, allowed me to go, okay, I need to get more. So I got more hungry about, what's out there, what others are doing. And I want to be part of that growth for myself, for my family, and for the future. So that's what property allowed me to do is, without knowing anything, going into a mentoring program, learning about it, seeing what others are doing, being around people that are commonly doing this, and then getting me the confidence to go and execute it myself. So if we were to look at a snapshot since 2015, this is how my deals spread it out, starting from 1 to 4, 7. So it kind of grew over time. But along with that, my deals got better. I was able to identify deals with better margins than previously. My network of real estate agents and tradies and people that I deal with grew, so that allowed me to progress a lot quicker. It's like they say, the the wheels were coming off the bicycle, and I was able to go faster and faster, and greater deals were happening. So that's what property does. If you don't know anything, you're always conservative, not knowing what to do. But once you have the knowledge, you could go further. And then coming on board with coaching, getting other people to do the exact same. Not why reinvent the wheels, copy what we do, and get same or better deals. But as you can see, along the journey of also changing my properties that I've traded, using that capital to buy passive income properties. So properties that I want to hold on for the future. So the first deal or the first home that I bought was up in 2016, which was the home and income. And I'll share that with you is that, as you can see in the next diagram, is that property there, the front house. So I took my knowledge of renovation. The property was run down, but I was not faced about it. I just went to the real estate agent and said, hey, I just need to get my builder in. And that was my building inspection to say, hey, is the bones good? And his words were like solid. So that was like next I knew how to transfer the home to, for my requirements. So that's what I did. So renovated the front property, moved in, rented the back. While living there, I kept an eye on the neighbor, talked to the neighbor and I said, look, if you're ever interested in selling your property, have a chat to me before we take to the market. We could maybe possibly do a deal. You could save on agents' money, open homes, and you could probably give me a bit of a discount. And that's what happened. So she was nice enough to sell me the neighboring property, and I'm having an eye on the back property. So it gives me this whole piece of land to develop in the future. This is the other property that I bought in South Auckland, in Fawana, which has potential to put 3 dwellings there. And this property here was our home that I bought, and that was intention of trading. But went through the property, looked at it, and said, okay, make a great deal to buy, renovate, and sell. But then it was a nice home in a bigger place, and I said, hey, this could work as a family home. Call my partner on. We both fell in love with the property, put an offer, and it's such a quick transaction in the sense it was first listed on Wednesday. I was there on Friday. That afternoon, I put an offer, got accepted with due diligence, and then to find out there were more offers coming in after the weekend. So it's about going in, acting fast, putting your offer through, and then I was able to wiggle a little bit on the price and go unconditional on that and did the transformation there. So that's what property allows you to do, is just to grow and development, as Lish said, is something that I've come on board and project managing that now. And the intention when I bought my properties in the past is the land, what could be built on it. So I could put 6 townhouses here, and that allowed me to grow my passive income, rent it out, and get passive income from there. So these are things that I want to do in the future, but sitting on the land to develop it later down the track. And the family home that I showed earlier, so I purchased for 965. The renovation was 185,000. Doesn't look like that now. It's all done and completed. I'm actually there now. So the value of the CV, current new CV, is about 1.65. Current market value is about 1.4. So I've got 250K worth of equity there that I can reuse. And it's not, when the market goes up again, and it'll be coming up to 1.6. So my equity or the value of my asset is going to grow up. So therefore, I can recycle, buy the next property, and so forth. But that's the whole deal with property is setting up for the future, buying the right deal, making sure it all stacks up and executing it. So next, I'd like to invite Maggie to share her stories. But if anyone's got any questions regarding my slides or anything that I've shared, pop them in the Q&A and we'll answer it for you at the end.
Always enjoy listening to your story because it's so inspiring. So I work with Slish and Fan at GRA. I help clients answer whatever property questions they have. So due diligence, problems with properties, how's my portfolio performing, should I buy this property, what's the costs going to be for a project, that sort of thing, and help look after Matthew and Celestia's properties as well. Like Van, I started off by attending training and courses as well, and invested in my education to make sure that we're starting to invest in property in the right way from the beginning, which really helps you make a good head start. And by avoiding buying dud properties, it helps you keep moving forward at a regular and steady pace. And if you can avoid buying a property that is a bit of a dud in terms of investment, then you're not set back potentially by years or hundreds of thousands of dollars. So it really assists you progressing forward. So part of that process of learning how to invest well was putting the right advisors in place. My JV partner and I started with a $300,000 revolving credit facility that was secured against a house that had been paid off. So we're able to do that in 2 full-time incomes, but not particularly high incomes, just your average income. And that's how we got started. So over a period of 4 months, so this was in 2015, sorry, 8 months, beg your pardon. Over 8 months in 2015, we purchased 4 rental properties that we kept. So a little 2-bedroom unit, which is perhaps not the type of thing you would ordinarily buy when you're investing in property, unless it was a fabulous deal and it gave you a strong rental yield. But it came as a package with a house and consented granny flat, which we did want. So that's the 2 properties purchased in January. A few months later, I purchased a house and consented sleep out. So next to the garage there, you can see the garage door, number 3. There's a little person door there, and you walk through in there, and there's 2 bedrooms and a bathroom. So it was all built under consent as such. So it's not one of those dodgy garage conversions. So we've got a house and a consented sleep out. And then in August that year, so 8th month, purchased a house and a consented sleep out. So that one looks like a granny flat, but it didn't have a permitted kitchen in it. So initially, when we purchased, the rent was a bit lower. You might have noticed it was only $4.40 per week, and that's because the previous owner had incorrectly leased or rented out the sleep out to separate tenants, and so we made sure that we took it vacant, so as not to breach any rules, which was very fortuitous because within a couple of weeks of settling that property, I got a letter from council saying they were following up on a complaint and understood that there were tenants in the sleep out living there as a separate dwelling when it wasn't correctly permitted or consented as such. And of course, that was the previous owner and we weren't doing anything naughty, so there was no issue. So those 4 initial properties that were purchased in 2015, just a really quick, simple snapshot. The total cost, that's across the top, which is purchase and the initial renovations and improvements that were done to those properties. And just applying a flat 5% rate, which is actually pretty indicative of the interest that we've been paying on the loans right from the start. So sometimes it might be a little bit higher, sometimes it might be a little bit lower. We haven't been particularly pinged by high interest rates, but we've also missed out on the really low ones because we're on fixed terms. So it's pretty indicative of what's going on in real life. So you've got the loan amount, the annual loan payments there, 13,000, 42,000, 45,000, 44. So those are principal and interest loan payments for that total cost. So 100% borrowings on this. Then the annual rent that's coming in. The additional costs are basically just rates and insurance because we do our own property management, and maintenance costs are fairly minimal because we tend to do all that ourselves as well, unless we need an electrician or a plumber, for example. So 3 of those properties are producing a healthy surplus, even though the loan payments are principal and interest, and the number 4 never did, and I could never figure out a way to make it produce a surplus, but overall as a portfolio it was still cash flow positive. So
Maggie, if we just go back to that initial one more then. So guys, when I was talking earlier, I was just saying, you chase properties that's got double income. And this is what Maggie is doing, she's chasing properties double income. Look at all her portfolio, it's all double income. Because when you can score properties with 2 income or 3 lots of income, your cash flow just goes next level, and this is what we chase. And I'll show you an example of a Rotorua property where I did. Sorry, Maggie, you can continue.
No, that's correct. It's a really good point. So after those 4 properties were purchased over that 8-month period, it was not too long after. Couldn't tell you exactly when off the top of my head, but they, of course, the values grew. The initial $300,000 revolving credit facility was completely repaid. Everything was fully financed and self-supporting itself. So we've got no actual personal money that we've saved from our jobs invested in that portfolio, and there's also no existing equity left in it. So borrowing against an original dwelling that has been repaid, looks after itself. There's enough income to pay all of the costs, and there was even over time sufficient rental income that was left over after your operating costs to improve the properties as time went on. And then we used that portfolio to keep growing. So that's sort of a snapshot of what was achieved in 8 months.
And Maggie, basically, what you're saying is you got into the whole properties, you did them up, you refinanced them, and you got out with all your money. Basically, you got the properties for free.
Yes.
Yeah, and to be honest, that's what we're doing every single day now. Buying properties, and that's what I was saying. The easiest way to make money is buy properties below market value. Instantly, you've created yourself an equity. Then what you can do is do a little bit of rent or refinance and grab all your money out. So you end up with getting the property for free. Yeah. Yep. Well done, Maggie. Sorry.
Thank you. So on the left, we start with that very first house that the $300,000 revolving credit facility was secured against. And in 2015, the 4 properties I just talked about briefly that were purchased over that 8-month period. We don't move particularly quickly. It was another 2 years before we purchased more property. The start was a property with 2 dwellings on it. Another 2 years before a property with 3 dwellings was purchased. And then 2 years later, we started selling a little bit to pay down debt. So we sold that property that was purchased in 2015 that didn't support itself because I was never able to figure out how to get enough rental income out of it, and sold the original house. And that allowed the property with 3 dwellings on it to be paid off, and also the little 2-bedroom unit.
Yeah.
And then at the end of that year, we purchased a home, and it came with lots of extra land. We did that deliberately so that it could be subdivided, creating 6 to 7 sections. And now we're sitting on a good day, maybe 5 million equity, and prices drop away, perhaps a bit less. There's development land because some of those rental properties can be developed, and also the home property is being developed as well. So we've ended up, from starting back before 2015, living with flatmates with that first little house rented out. Now there's all that equity, there's development land, there's a nice home, there's sections to build on, and there's currently $6,785 per week coming in rent, in the process of increasing some rents, so that's going to grow to $7,410. Now most of that still goes on principal and interest loan payments. But recently spotted dual properties. I think they were somewhere down in Christchurch, so duplexes. They were asking $1 million for them. And sort of realised, well, we could sell up the existing rentals and use the equity and buy 5 of those and be debt free. So,
Yeah. And this is a good example what Maggie is showing, because what Maggie was saying, they were, on just normal income, normal mum and dad investors, right? Not that Maggie is so, sorry, Maggie, but but normal, normal couple went out, and they did this. That's what we're saying. You don't need to be some sort of high profile person to get into properties. Most property investors are mum and dad investors, just doing normal things every day.
Yeah, so it's taken 9 years, and we could potentially retire.
Yeah.
And we worked right the way through, so held down full-time jobs. We didn't buy a lot of property, as you can see, after the initial spurt, 1 every 2 years, so it's not overly taxing.
Yeah, absolutely. And I think when I said earlier, it only takes 7 to 10 years to create yourself a portfolio. And look at what Maggie's created for herself. What a gorgeous portfolio. Here's a little bit of story about myself and how I got started and what I did. So I started here work at GRA in 2007 as a graduate accountant. So back then, you sat in your office and you data entry with those big white computers. You didn't have the flat screens like we have this massive screen now. And, I sat there, and I didn't have any glasses back then, so I was young and all of that. But over the time, looking at all the numbers, I had to wear glasses. So I did data entry where the clients would walk in with their shoe box and go, here you go, sort out my GS2 10s and whatever, and they'll leave. So you do the work, you send them a bill and all of that. So I was broke with about $47,000 worth of loan. I still remember this day. It was $30,000 on my student loan, and I had $16,000 that I bought a black Ford Falcon, and I spent $1,000 on mag wheels because I live out west, right? You're Bogan, right? You got to drive black on black, and all my mates started calling me Knight Rider. That's what the car looked like. But I'm glad I did it, so I can live to tell you the story. And then now I've got $50K a month property growth, and I'll tell you in a sec what that means when I go to the next slide. So in 2007, I explained to you what my debt level was, 47 grand. In 2010, I started buying properties. And the way I learned about properties is going to seminars like this. I went to property seminars and I learned about property investing, how to do properties and things like that. So in 2010, I bought my first property, and I bought it for about 40 grand discounted. So there was a lot of money back then, 40 grand discounted, which allowed me to use that 40 grand as equity to buy another property. And today we are in 2024 with over $42 million of property in our portfolio. Now, so that's over 14 years. And remember, when we started the presentation, I told you when I turned 30, I could have just gone into retirement, and I didn't because I wanted to grow the portfolio. And we're going to keep growing our portfolio. We're increasing the size of our portfolio. Now, if you look at my earlier slide, I said I make $50,000 a month. Now, whatever I do, I try and make $50,000 a month in property, either by adding value or doing projects with then or buying sites, developing and things like that. But I always make more than $50,000 a month. My threshold is 50, right? I have to make $50,000 a month. Now, because this is adding value to my portfolio and my whole portfolio, I don't have to pay tax on that. I'm just growing my portfolio every day. So that's the beauty of doing an investment portfolio that you can grow. But that's nice to be sitting at $42 million of property portfolio today, and we are growing. We are also cash flow positive. We're about $400,000 a year cash flow positive on our portfolio, and we get about $7,000 daily rent coming into our bank account. So every day we get $7,000 coming back. Now, what we do with all our cash flow is we're just paying off our debt as fast as we can. I only borrow money if I go principal and interest repayment. I'm not interested in going interest only. Has to be principal and interest. So that's how basically I've grown my portfolio over the years. So here's an example of a property with 2 lots of income. This is why I keep telling you guys, you got to buy properties with 2 lots of income here. So if you look at this particular property, we've got a front house, 4-bedroom with the little 1-bedroom unit at the bottom. Then we bought the back house as well, 3-bedroom. We paid $515,000 for it. Our renovation was $35,000. Total cost was $550. This is in Rotorua. Market value came back $850. We refinanced, got all our money out, maybe more, and so we instantly made 35% equity. Currently, the property is rented at $1,300 a week. It gets $67,000 a year in rent. After we pay our operating expenses of $11,000, we're 70% geared on the property. We pay 4% interest, $15,000 goes back to the bank. We end up with $41,000 in our hand. All we're using that $41,000 is to reduce our debt down as fast as we can, right? We're not taking any dividends out. We're leaving all our profits in the property investments, and we're paying off our debt. Now, the other thing about this property is it's 1,000 square meters of land. I can bulldoze these houses out, and I can build more dwellings if I want to. Now, I'm not going to do that. I'm going to keep enjoying the cash flow that we're getting out of this property, and that's what we'll be doing. And we'll be just paying off the debt. Once it's all paid off, all the cash flow comes to us. Now, this is the kind of properties that I'm telling you to chase, double income or triple income, because you've already got the site, you end up buying the big site, you've got triple or double income, all of that. Now, this is an example of a property I bought in 2010. Now, you must be wondering, why am I showing you what I was doing in 2010? Because what I want to tell you is 14 years later, I'm still doing the same thing. I bought this property for $320 front house. Then I spent $290 on the back and $30,000 in the front renovating. So I built a house at the back. My total cost came to $610. My projected market value was $1.6 million. My instant equity was $990,000, which meant I got to use this money, refinance, and buy more properties. So today the property is rented for about $1,200 a week. We get $62,000 rent minus all the expenses, about $7.5. And I've just paid the loan off, so I get basically $55,000 a year in my pocket. And I'm now using this cash flow from here to reduce the debt on other investment properties. I'm paying all the debt down as fast as I can. So this is the beauty of doing land banking investment. So my land keeps going up. I got double income coming through, and my cash flow is really good. So this is the kind of properties we chase, and this is what I want to chase. Now, a lot of people go to me, why do you give your secrets away and all of that? Because I want people to invest. When I started investing, someone told me what to do. So the best thing I can do is share my knowledge and get you to do property investing as well. Now, here's a couple of my other sites in Rotorua that we've bought over time. So I'll start off here. So we bought the front house. We paid $400,000, spent $50,000 renovating. It's rented for $600 a week. So it's a 1,000 square meter site. The back one came for sale. We paid $500,000 and we spent about $50,000 renovating, $550. So for about $1 million, we ended up picking up 2,000 square meters of flat land that we can put 20 units down. It's got 2 road access, right? And we're not going to do this. We're just going to enjoy our rent. We get 1,400 a week rent, which is going to enjoy our rental income from this land banking. So we're doing land banking and we got cash flow coming. And then here's this property on the right. We bought this one here initially, front and a back unit. We paid 500,000 plus 500,000 to renovate. Sorry, 50,000 to renovate. 550. We're getting 810 a week rent on this one here. Then we bought the neighboring property came up. We bought that for 500,000 as well, and that's rented at $700 a week. So now we own 2,000 square meters of land. We can subdivide and build. That's the beauty of this land banking asset again. So our current strategies, what we've been up to. So here's some of our latest hold that we bought. So this one here was bought in March 2023. We paid $480,000. We renovated for $50,000. Total cost was $550. It's 2 dwellings. Again, there's a dwelling here and a dwelling here. It's rented to social housing at $900 per week. So our total cost is $530. We get $900 a week rent. Now that's pretty good rent. That's amazing rent, And this is the kind of assets I chase, and I buy them all the time. And I'll show you more examples as we're going. So Maggie, do you want to tell us about what you've been up to?
Yeah, so we've been taking existing rental properties that needed some improvement. Clearly, it's the photo on the with that house with the ute parked outside it shows, and improving them, spending a certain amount of money, but getting a massive rental increase. So that horrible 2-story thing there, 50,000 spent on that. Repaint, recarpet, freshen up the bathrooms and kitchens, but not completely replace them. New curtains. It's quite a big house. 50,000 spend. Rent increased $450 per week, so 47% return on your money. And it's that kind of change in your figures for a rental property that helps your serviceability calculations that a bank does when you want to grow your portfolio and borrow more. It's for not too much money spent, in this comparison to the cost of a dwelling, I'm talking, you're getting a big rental increase, so that helps your ability to borrow more. The other house there looks nice and tidy on the outside, but internally it had tenants for many years that were very hard on it, and it was pretty much trashed. I say trashed, I mean there weren't holes in the walls and things, but it was everything needed to be redone. So that was probably for a similar spend, about 50-55. Smaller house, but we did more to it. So repaint, recarpet, new curtains, new bathroom, and new kitchen. Managed to get a decent payout on insurance. So overall, it was 30,000 after got a cash payout. Rent increase $250 per week, so it's a good return on the cost of that.
And fantastic. And not only that, you've added value to the property as well, right?
Yes.
Maggie? So you've added value, you increased your rent, and these are small things that you can do to your property, which actually shines, and well done to Maggie for identifying this. Now, Thane, do you want to tell us what's happening here?
Oh, yeah. So this was a development that we'd done last year. We're just almost we're waiting on new titles to be issued, which are coming up shortly.
Actually, it's been issued. I got a text just now.
Oh, you got a text? Oh,
Yeah,
congratulations.
Yeah, thanks.
That's cool. So it's all done. It's been rented out. So this was in central Auckland. We got bought the land, but got some resource consent and building consent and everything. Built 4 houses, so that's 2 duplexes. As you can see, the price for the land and subdivision was about 1.5. The building cost was about 1.5, so the total cost was $3 million. The market value is 4.6 to 4.8. So the equity gain there is about 1.1 to 1.3 mil. But also, Salesh, that's been rented to social housing, I believe?
Yeah, so we've rented a social housing provider that's it's on a special contract, so it's used for disability homes. So it's the 4 of them is rented for about 4,800 per week on a 20-year contract term. It's been rented out. Yeah, and obviously it's good. I think they've managed to house 18 people in all the rooms. So, well, how many rooms are there? 3, 4, 12. Sorry, 12 tenants.
12, yeah.
Yeah.
So,
12 tenants a lot.
But no, they were pleased when we handed over the keys then when they moved in. So,
yeah,
and they're looking to move in.
And so what you got to remember is you got 12 tenants times 5,000 a week at the motel. It'll cost the government 60,000 a week. right? Whereas they get a house like this for $5,000 a week, you know?
Well, the
So
four houses.
the 4 houses, yeah. So instantly the government saves 55,000 a year, a week, right? By renting a house like this. So this is why the government's out there renting all the houses now. They want people out of the motels because it makes sense to put them into houses, you know? And then this one here.
Oh yeah, so this one is in Tierra 2 South. So we've started the demolition is done, and we've done the earthworks, the retaining wall. It's fully fenced, and in fact we've got meeting with Watercare tomorrow, so that 9 o'clock in the morning, and then we're going to start the drainage, the public drainage work later this week. So that's the consent for 8 units. I believe from memory they're all 2 bedrooms. So the purchase price is 1.35 for the land. The development and build cost is going to be just over 2 mil. So the total cost is 3.4, and the market value, and there's, this is current market value. We've got a registered valuation and everything, and that's going to be at 5.7 mil. So profit of 2.3 mil, or equity gain of 2.3 mil down the line. So about, what are we looking, about 9 months to complete this, and so this is a nice project. The neighbors are a bit funny, but I'm enjoying it.
Yeah. We should send Maggie over to sort out the neighbors.
Yes.
Yeah. So this is our current site here. So if I look down here, see where the white car is parked, and all the way up to that wall, we bought this piece of land. This is in Glen Eden, right next to the railway station. You can see the railway there. So we've applied for resource consent to build apartments. So we're right next to the railway station. So you can just come out of the building straight on the train platform, and you catch a train to the city or to West Auckland. So building 90 apartments here, and there's 10 commercial units going in as well. And there's about 60 car parks. So we were very lucky. We bought the land for 1.4 million 10 years ago. It didn't feel like we were lucky back then. Felt like we'd just been charged this ridiculous amount of money for a piece of land. Our neighbors have all built houses, apartments like this, and they're 100% occupied. Right. So we've so our total cost for land was 1.4 million. Our total cost for resource consent and building consent is about $1 million. So our total cost will be 2.4 million, all up once we get our resource and building consent. We're looking at $8 million in value with resource consents once that's out, because we're building 90 units here. Now, obviously, once we get all our consents in and everything, then we'll go for bank funding to build them. And if we do build them, we'll either rent them all out to social housing providers, or some of them would be sold, some of them would be rented. We haven't decided what to do at the moment with the end product. But yeah, so we're busy working on our resource consent with this site here.
But you've created a lot of value there just in getting the consent.
Yeah,
It's obviously a substantial investment in getting that consent, but you're
come out 6 million better off.
Yeah.
Yeah. And to be honest, like it's not luck. I don't use the word luck. I think you don't get lucky. It's a strategy and how you use it to your advantage. I think that's what you got to do. And that's what we're doing here. So we're quite excited to build this, because this changes the look of Glen Eden, and it'd be nice to build something like this. So how do you start? So obviously you're listening to Than, you're listening to Maggie, you're listening to me, you're going, oh man, these things are very complicated. And they are. Trust me, they are complicated. But once you do a few transactions, you get a few under your belt, you know who to talk to, who to use, and all of that. So what we've done here is we've set out a road path for you. And basically, you need to work out where you are now. So if you look at number 1 down here, work out where you are now. Work out where do you want to be. So if you're in Auckland, you might go, okay, mum and dad, 2 little kids, we want a house in Auckland, we want a batch, right? And we want a couple of rental properties and all of that. So yeah, you might need $4 or $5 million as your working capital to get going, So those are some of the things you need to work out, because it's good to work out what you want and where do you want to be. And then you get the right knowledge. So what we offer is property school and development school. Now, if you have done property school, then we recommend you do development school. But if you haven't done property school, we recommend you do property school. And the reason why we encourage our clients to do property school is because the amount of knowledge you get out of that is next level, right? And also you get to watch the recordings again and again if you need to. Then once you've done that, you get a strategy in place. You get your advice, get strategies in place, get your structures set up. Now, structures are very important prior to getting your finance. Because if you go and get your finance in your name, then you come and see us to put structures in place, your bank won't be happy. They might even go to the point of saying, well, look, we're not going to look at this finance again. So get your structures set up first, then we go to the banks for finance, and we'll help you get finance.
What do you mean by structure, Suresh? That might be worth just very briefly.
Yes, sure. So when you say get your structures put in place or set up, we're referring to a family trust, company, investment trust, or anything like that that gives you the most tax efficient position. Also asset protection as well, because we want to always protect your family home, right? So once we give you the structures, then we'll hold your hands all the way with your banker to make sure your banker understands what we're proposing, and then your finances arranged. And once that your finances in place, you can go out and buy houses. Obviously, and also we recommend running your purchase by Maggie or Then as well. It's the best investment you'll do, having someone else independent to check your investment and see what you should be paying for.
Yeah, so basically saying don't rush out and buy a house, because it may well turn out not to be one that you should have purchased, or you've used the wrong structure to purchase it and it's not tax efficient, or various other issues.
Exactly. Now, anything else you want to add here, Maggie?
No, I think you've done a good job of explaining that.
Fantastic. Well, you can tell us what Property School is, Maggie.
So Property School is out as an online course, so it's available on demand. You can view the recordings whenever you wish, and you've got access for 12 months, so you can, as Suresh was saying, you can watch them as many times as you like. We have a mechanism where you can send in your questions, and they will be answered by the most appropriate person at GRA. So say if it's a trading question, for flipping property, it's probably going to be Than. If it's a tax question, it goes to a tax consultant, etc. It's basically a program that takes all our combined knowledge and presents it in a educational format. So you're gaining insight and knowledge right from the basics to more complex types of investing. All of Sulesh's experience and all of Matthew Gilligan's experience, he presents a number of topics. So it's really a huge amount of content for a minimal cost. And as Suresh will say, it's not done to profit from, but to help GRA clients succeed.
Well, Maggie, what did you spend on learning about properties?
35,000.
So 35,000. That was in 2015.
Plus Property School.
Plus you came to Property School, and
yes.
you well, let me jump in here. You cannot put a dollar value to education. It's the growth of years.
well, Then has lower IQ levels. Then how much did you spend on property education?
So I spent about close to $100,000 in property education. I mean, look, I didn't start with not knowing what a sales and purchase agreement looked like, but and then looking back at it, it is money well spent for me. Because it allowed me to grow and progress and be where I am at the moment.
Well, like I said, Than's was a little bit slow, so we had to do the same class twice. But look where he is now, so it's definitely worked. But what we're trying to tell you is that this is about $500 course that we're offering you. It's not about us making money out of this. We just want to educate you. And look, I can take you back, 15, 16, 17 years ago when I sat in front of investors like this, and we said, we're going to go and buy properties. This is what we're going to do. They've all become multimillionaires, right? And you look at Maggie, you look at Then, they've all made their money through sitting in those classes, working out and all of that. So this Property School is an information sharing place. We're sharing information with you, right? And that's quite important. So that's why we want you to do Property School. We don't get commission from selling it, none of that. We just want to give you ideas. Now, the other advantage of doing Property School is you get the list of supply chain, the lawyers, the bankers you should be using, the insurance agents you should be using. All that comes through Property School as well. So, and if you forget the content you're watching, you can watch it again and again, and all of that.
Later this year, we're actually running a live online course. So it'll be up to date and updated with the latest property deals and the latest tax information and the latest town planning information.
Yeah, absolutely. So basically, Property School is an online on-demand course. So it's online. You get 12 month access, 12 months access to the module. To be honest, I don't know if someone ever checks if you've how many months access you have. So you can probably watch it again and again. We don't care. We want you to watch it again and again. We want you to understand. So you might watch it tonight, not understand it. Watch it again next day. If you don't understand, make a time with Then and Maggie, and they'll give you a hand with it. You can also send us questions, and we'll answer them as we go. There's also, you get access to 7 weeks WellSuite access. This is basically where you put your statement of position. It shows you where you're going to be in 10 years' time and all of that and the changes you need to make. If you do buy a property school today, if you do sign up for it, if you sign up for property school today, you'll get a free initial meeting with one of our GRA tax consultant, which is about 500 plus GST an hour. Right, so you get it for free. This is only applying to non-GRA clients. So if you're new to GRA, you'll get it for free. Now you'll also get a book of your choice. So you got Property 101 down here, or you got Tax Structures. Now, because Maggie and Then are having a good day today, we'll give you both books. You can have both, because the more you learn, the more we feel good, right? See, once you learn property school, it's about a skill for life. You know, we teach you how to do things. We teach you how to make money. So if you are keen to do property school, you book online, and that's your website there if you want to book. Now, you might go, no, I don't want to book for property school. That's fine. If you just want to have an initial meeting as well and you're a non-GRA client, you can email Amy, and she'll organize a free meeting with us. Don't be shy. If you've got questions, flick them to us, email them to us. None of the questions are ever dumb, because it makes us think as well. When you ask us questions, we think about your question. We go, how are we going to answer that? Now, normally property school is $5.95. So if you sign up today, you pay $4.95. Now, if you've gone ahead and signed up for $5.95, don't worry, we'll send you $100 back. And also, if you'd like to know about GRA events, property seminars, and all of that, you can go into our events website at the bottom link. You can follow that, and obviously register yourself as well.
Yeah, so there's more information there about property school. Before we talk about development school, if you do enroll for property school now, you'll be watching the current recorded version of the program, but you'll also have access to the live course that we'll be running later this year. So we don't have dates set for that yet, but we're keeping a list of anyone who enrolls in the current version, and you'll be invited to join us on the live program as well, and that'll be no additional cost to do that, so you get the updated version. Development school is a course, sorry, tongue-tied there for a moment, focuses completely on development. So it's suitable, it starts at beginner level, so you don't necessarily need to know much or if anything about development. We start off at the basics, but then we do move quite quickly because there's a lot to cover. So it's suitable for beginners, or even if you've had a go before, or you think you know a bit about development, or you do actually know a bit about it, you probably still find this course quite valuable because there's a huge amount of content on here, and there's a number of specialist presenters that present on their specific topics. So, for example, loan broker that specialises specifically in development finance, a town planning consultant, a builder, developer builder, it comes along and talks as well, a development project manager. So there's a variety of experts. Quantity surveyor is another one that springs to mind. And then we've also got expert input for all the various different topics that are covered. So for example, a geotech engineer has given us input on the aspects that cover the area of expertise, a surveyor, solicitor, all about titles and the legal components of development. So basic, very comprehensive course that starts off the basics and leaves you very well informed if development is something of interest to you.
I guess it's we do cover a bit of it in property school, but I guess it's just a lot more information, a lot more things when it comes to development school, and that's why that's done separately. And sometimes development is not there for it's not for everyone. So guess where to from here, Salish? Do you want to come on board and tell us your recommendations?
Sorry guys, I just had to pop out for a sec. Yeah, so basically, where to from here, guys? So what is it? So this is some of my recommendations. Now, this is obviously not Bible. This is this is what I'm going to tell you. So don't do nothing, so don't just go to sleep and go, okay, forget about it. So you got to act sooner than later. Like I said, anyone I talk to now, they go back. I wish I did this 10 years ago. Don't use lack of time or fear as an excuse. That's important. Don't just go, I don't have time. Again, just look at your screen time and how many hours you're spending on your phone. Draw yourself a timeline with targets. That's quite important, so that's very important you do that. Surround yourself with the right kind of people. Now, when I said draw yourself with a timeline with targets, I'm referring to 7 to 10 years. Where do you want to be? And you get yourself there. I did this at 26, where I wanted to be at 36. So I did that. Surround yourself with the right people. That's very important, So again, you could have family members that are talking you down and all of that. Don't do this, don't do that, and you think long term when it comes to property investing, right? So that's quite important. So that's some of my recommendation that I can give you. Again, I've thought through this. I go, what is it that people are scared of, and what is it that makes people nervous? So this is my recommendation. Now, what I'm going to show you is a text message that I was showing to Maggie years ago, and Maggie said, oh, we should use this in our event. So this is basically a client and me. I'm the one in blue and the client's the one on the left. So the client goes, well, this is a success story. This was a client in GFC that was sitting on negative $1.5 million equity. I've been updating my wealth suite. I'm sitting around $7 million just in property. Been big gains in last 12 months, probably last 6 months. Yeah, you should be over $10 million in net worth. When I said 10 million, I meant his business as well. You have done well, mate. He goes, wow, yeah, maybe $10 million, but doesn't feel like it, but thanks. And you helped me a lot, so I appreciate that too, bro. Now, I did help him a lot. I'm trying not to say his name, right? Because he's a very, very good mate of mine now. And but what we did here is we sat with him, we worked out a plan, and we stuck to it. We didn't come off it. And also, even he goes on saying doesn't feel like it, he's got $10 million, is because every $1 million you make, it doesn't really change your lifestyle anymore. You've done the hardest yard making your first million, and then you made more and more. So at the moment, he's probably worth close to 18 million now. And that's in the last 2 years. He's gone from 10 to 18, right? Because he's worked out how to do it. And together, we do it together and make decisions. And if you look at my last text message to him, I think it's just sticking to the game plan. Buy properties, pay off debt, buy good assets, land bank, cash flow positive, etc. That's what it is, and that's the main thing we need to look at here. So that's basically is my golden ingredient. I don't come off that. Yeah, makes sense, guys. Yeah, and okay, so this is quite an important website or important information I'm going to share with you. Everyone that owns a property, you need to look at your insurance on your properties. If you bought properties 10 years ago and even checked your insurance, you could only be covered for $300,000 on a 4-bedroom house. It costs you $1 million literally to replace a house now. So you need to look at your cover, redo your cover. I've done this myself. I've gone and reinsured all my properties, right? And very important. So I suggest anyone that owns properties, call your insurance company, check your cover, make sure they have a copy of your tenancy agreement in place and all of that. And also, you've got to remember personal insurances as well. This is quite important. So you need to have personal insurance in place as well, because currently with healthcare, if you got healthcare in place or with NZ Healthcare, there's not much there. So you need good healthcare in place. So that's important. So we use a guy called Steve Munro at riskdirect.co.nz, and you can jump on his website and he can help you put personal insurances in place. So Maggie, this is do you want to tell us what's happening here?
Yeah, so for people who want to keep up to date with what GRA is doing, you can sign up to a regular newsletter. You can follow posts on LinkedIn or Facebook. So the URLs are there, so you can find GRA easily. And there's always things popping up on the website or on our mailing list whenever Matthew and guests do a new webinar on specific topics, for example, tax updates or planning updates. There's regular blogs on the websites. as well. So a good way of keeping up to date with changes in legislation, for example.
Yeah.
So anybody who would like an initial meeting, this is with a tax consultant. It is free for new clients that haven't had a free initial meeting with GRA before. We also have a minimal charge if it's you've previously had a free meeting but require another one. And that is the pathway for clients to get advice on asset protection, and tax planning and advice, and for accountancy services. If you want some other type of meeting or property advice from myself or Than, you can email Amy. So there's her email address there, Amy with 2 E's, b@gra.co.nz, or just phone the office and ask for Amy, and she'll be able to book meetings for you. And there we've copied the URLs for Property School for the special $4.95 offer. And remember, if you enroll now, you're also invited to the live online version once we're running that later in the year. That's included in the price. If you want to know about development, enroll in Development School. And if you require anything else, you can complete the RFI form, which you can find at gra.co.nz/request for information.
Absolutely. And like, again, this is all quite informative stuff here. I mean, if we got GRA clients watching, that they'll tell you we are quite informative and things like that. So yes, if you do need one of our meetings, fill out those forms and Amy will get in touch with you.
Carson is very curious to hear more about the social housing investment strategy. What type of property qualifies for the scheme and how to initiate the process?
Yeah. So basically with social housing means you're renting a property either to KO or one of the service providers who are basically contracted to the government, and they have a list of tenants to house. Now, what social housing means is, and a lot of people think social housing is rough tenants and all of that. Well, they're not rough people. They're basically your normal tenants, and they could be a single mum with 3 kids, or mum and dad who can't find houses, so they've gone through social housing and they get a property. So they're good people. And like I said, I've done social housing for 14 years. So what kind of properties qualify? So what you should do is basically follow us into Property School. If you want to know what social housing is, how it works, you just Google social housing in the particular area, and you'll get a list of providers. You can contact them directly and see what kind of properties they're after. So that's how you basically get into social housing. Yeah.
Okay. Dave asks, changes to interest deductibility. Have the rules changed to allow interest to be claimed for rentals purchased after 21 March 2001? I think that's probably a typo.
2021, yeah.
21, yeah.
Yeah. So what's happened now is from 1st of April 2024, so we are 15 days into it, you're allowed to claim interest, or 80% interest against your rental property, and from 1st of April 2025, you'll go to 100%. So it's happening. So it's, National Act and NZFest are making the changes for us.
Mm-hmm. Right, Jay says, hi Salesh, how do you build the team to be able to do the flips and be buying and holding at the same time along with your accountancy, or is everything outsourced?
I'll tell you this, Jay. I'll answer that very, very nicely.
That's why he's got us.
Well, firstly, I don't do social media, so I don't look at my phone 24/7. If I'm looking at my phone, I'm working. If you guys want to score your time back and you go, where do you get your time? Just look at the screen time on your phone and how much time you spend on social media. It's ridiculous. So that's why I'm not any social media. I work 7 days a week, right? I'm always on the phone with everyone, and I abuse Than and Maggie like anything for information. Yes, you have to build a team around you, right? And what you do is you call them for help. You don't annoy them. You call them for help. And actually, Than is our project manager. He runs most of the project, and Maggie does all the paperwork. If Than needs help with that, so Maggie comes into play. And so we build a team around this. But yeah, we literally have to work 7 days a week. But I enjoy what I do. If I don't get a call from anyone, I start getting nervous that something's not right. You know,
But you don't
so
work 24/7, Celeste. You're making it sound a bit extreme. I mean, you go
well,
fishing and used to have time with
oh
your
yeah,
family.
yeah. But if I'm fishing and someone calls me, I'm on the phone straight away, and I'll start talking through it. Ask then, you know, like or whenever, you know, I'll always attempt to answer the phone call and get it resolved. Like that's one of the things. But in the weekends, I'm on site. I go to the sites. In the weekends, I'm looking at the portfolio or replying to the banks or getting all that done. When I say we work 24/7, what I mean is we make ourselves available. You know, we don't go, oh, we're going out fishing, so we're not going to answer the phone call. It doesn't happen like that. We answer
Yeah,
the
because you
phone
could
call.
miss out on a deal. Or
Yeah, could miss out on a deal or could be something important, you know. So it's just a matter of putting effort into it. And I think the biggest thing I've seen that's really changed in the last 10 years is people are spending too much time on social media. And I think it just sucks time out. And so if you take social media out, which we didn't have when I first started going into property investing, you know, we used to spend so much time on the road looking at houses, you know, and all of that. Instead of Googling it, we'll drive to the road. Now I can Google a property, I can look at the listing, and I can within, even without going to the site, decide to buy the house. You know, that's how much the technology has changed now. Yeah.
Well, the online information is wonderful because not only do you get the listing, but then you can look at all the information that council has available, the aerial photos, where the services are,
Yes.
Google Street View, and suddenly you've pretty much viewed the house
I was
without
going to
going there.
show you a property that Then sent me information on, which I looked up and I emailed to Then. I said, look at this property, it's so cheap. And then instantly, I'll show it on my phone. He sends me a photo of this. Now, what that shows is the property is in the flood path. So you'll never be able to finance the property. You know what I mean? So that's the importance of no wonder it's 1,000 square meters worth 700 grand in Auckland because it's got a major flood path. It's going to flood. So, but that's the important of having a team, you know. Someone finds something, the other one steps in and goes, have you checked this? Yeah. So there you go.
Dean says, do you have any insights when or if the current 5-year Brightline period will be reduced?
Well, the current Brightline period is 10 years, not 5. It's going to reduce to 2 years from 1st of July 2024. So from 1st of July, well, now what we haven't got is detailed information, but we know this is coming in. Yeah.
So not long to wait.
No.
Kayla, if I've pronounced that correctly, says, my husband and I are out shopping for an investment. Is it worth buying a 1950s house with asbestos cladding? We can't afford to reclad, but possibly improve the appearance, etc. Thoughts?
I mean, I'd love to hear Then in your view, but I would say if you can't afford to reclad or get rid of the asbestos, don't touch this property. 1950 properties require a lot of maintenance work. Unless you're picking it up for next to nothing, like 50 or 60% discount, or maybe more. And also you have to check with the banks if they will approve the loan for you to buy this property. That's the advice I'm going to give you. What about you, Then?
Yeah, I was going to say price first. You know, what's the numbers? How does it stack up? And to be, you know, look at from a price perspective, you know, and also the condition. Does it have to do the work right now? You could buy it, rent it out, as long as you're not touching it and no harm is done, and then, you know, work it out in the next 5-10 years later on. So, you know, without knowing where, location, market value, what's going to be renting, cash flow, it's hard to give you an answer. But, you know, those sort of stuff I encourage you to look into before, you know, going through.
Yeah, so I would say without knowing anything else, because there might be reasons why this property is particularly appealing. For example, it's got big backyard that you can put other houses on, and assuming you can get finance, as you pointed out, Celeste, I'd say if you're buying it, it has to be at a price that makes sense to spend whatever it costs to replace the cladding, because one day you'll be wanting to sell it and the buyers won't want it, so you're going to need to reclad it at some stage, otherwise it'll always be being sold at a discount. And so even if you don't do that reclad work now, when you might not need to, it might be perfectly safe to rent out. Or
and whatever your budget is to reclad or whatever, add another 20-30%. Because when you reclad, it always gets out of control.
And depending how long you're waiting, of course, those costs will be higher in the future.
Could be 100%, it could be 100% out of budget. So if you don't have the money, don't do that. Go and buy a property that's already set up properly and pay a little bit more, but get a property that's hassle-free. That's what my recommendation would be. But always check with the banks. Anything to do with flood, reclad, asbestos, check with your bank before you even put an offer on a property.
Yeah. Rex says, we are now looking for our first investment property. When buying under market value, what percentage undervalue are we looking for? What percentage is realistic but won't hinder progression as we are in the early stages of investing?
I personally think in this market, you could buy a property with a CV of 900 for probably around 750, a really, really good deal. So that's what I'd be chasing if I was a first-time investor, because I really want that 150 equity on the books for banking purposes. Now, that's obviously me. Then, Maggie, what's your view on this?
I guess the ideal solution is that you get cash flow positive, so your rent pays all your mortgages, principal and interest, and the equity is 40%, 35% that you can get all your money back and recycle it. But that deals are hard to find. No, I never come by. But that's the ideal goal. But essentially, like I said, you want to be looking at 10 to 20% equity gain in any deal that you go, because you sit on it now, and then over time, your equity position is just going to grow. So always don't pay market value. Always look for a discount.
Always negotiate. Always negotiate. Yeah.
I would add that it's not too difficult to increase the value for a property, especially if you're talking about an existing property on some land that has scope for improvements, because if you do those improvements cost effectively, you're increasing the value and creating equity. So and over time, as you keep investing, it's not the equity that ends up the problem, it's the cash flow that you need sufficient rental income to still qualify for further lending to grow your portfolio. So just as important is to think about the amount of rent you can extract out of that property with improvements.
Yeah.
And changes.
Agree.
Unless you're high income and you don't have to worry about it.
Yeah.
Right. Jay says, what is the best way to secure tenancies with the government? Is this something that a new person has access to, or is it because of existing relationships? If you could guide me on how you would approach the scenario if you were starting out fresh, that would be great.
Yeah, so Jay, I mean, if you are a GRA client, we'll be happy to guide you through the process and all of that. And basically, like I said to you, I mean, first thing is work out where you want to buy, work out what can you afford, right? And then based on that, you can give a social housing provider a call. But if you are a GRA client, we obviously have different relationship, and we can hook you up with our contacts, but we try and save that for our GRA clients, and we refer them to social housing providers for that.
But I'd add to that, though, insurance can be difficult when you're renting for social housing, and the need for it isn't necessarily exist there anymore for you. I'm going to say mum and dad investor, because they're getting interest deductibility back.
Yes.
So it's not critical like it was recently to try and get into that social housing space. Yeah.
The only advantage of going into social housing is, yes, you get your rent on time. There's no management. And you can sign a reinstatement clause. The disadvantage is your insurance, because you must have insurance. Otherwise, your bank will call up your mortgage. So you must go to a provider who provides the insurance to cover. Always give your insurance. This is for any investor out there. Always send a copy of your tenancy agreement to your insurance provider. Very important. Very important. Always do that. Maggie, I don't know if you've done that then. I don't know if you've done that. I would send them copies of the tenancy agreement.
I honestly can't remember if they've asked for it at the time of.
No, mine hasn't asked. Yeah,
I'll just send them a copy. Doesn't matter if they ask for it or not. Just send them a copy. That's what I did. I picked up all my tenancy agreement and I sent it, over 50 properties, and I said, here you go. I want you to have this.
They always ask for them when you're making a claim.
Yeah. But it's just why have a fight with them later?
And they also always ask for proof of your inspections to too. Carson at Than, regarding the reno and sell strategy, do you run it through building consent all the time, or is it more pragmatic to focus on renovations that don't trigger council consent?
Well, when I started off, I wanted to keep it simple and in and out as quickly and capturing the current market. So, consent sometimes can take a longer period to go through the hurdles. But over time, I think I've got more confidence in dealing with council. And now I'm like, if it requires a consent to do the work, and if it's going to add the extracted value that we want to, definitely. But if it's something that's straightforward, we could just do it under exemption work, then by all means go through it. If it's your first trade or someone who's slowly starting, I would recommend maybe look at an easier deal rather than getting it overcomplicated through council. But it's not hard, and there are also third parties that does help with if you're wanting to deal with council, they'll come in, ex-council people that have obviously started their own consultations firm or companies that could help you through that process.
Well, it really just depends on what you're proposing to do to a dwelling, because it either triggers the need for building consent if it's work that needs consent, or you can do a few different things like add walls or knock out a wall, I believe, if it's not load bearing off the top of my head,
Yes.
or swap out a window with a ranch slider or a pair of French doors, provided it's no wider than the window was.
Yes.
So, with cosmetic renovations, you can replace your kitchen and bathroom without consent, as long as you're not changing the fixtures, the plumbing fixtures. So
Correct. And not
you can
changing the
you can
time.
do a lot perfectly legally without consent, because it's work that doesn't require consent.
But then, yeah, always look at what your end goal is, why you want to go through that avenue, and if it requires consent, allow that in your time frame of renovation, budget that in, extra holding costs, so that it looks into your margins at the end. Because last thing is having to wait 4 weeks or 8 weeks for some consented work, that's just going to cost you while you wait.
Mm.
And the other thing is, some
Absolutely.
of the old properties have safe and sanitary report as well. So don't rush and just start going to the council. You probably want to get a guy who's specialized in safe and sanitary report to use their skills. And obviously, if you're part of GRA, we can help you with that as well. Yeah.
But we
sorry,
wouldn't
Nikki.
recommend avoiding getting consent if you require it, because otherwise you just
Yeah.
end up with
Yeah.
unconsented work and an unsaleable property, and potentially one that no one wants to insure either.
Yeah. Absolutely.
Carson has a question for me. With double income setup, do you have recommendations as to how to effectively split and manage the utility bills? Well, Carson, with dual income properties, you should have separate power and water supply to those properties. So they would automatically have separate utility bills for the tenants. It would be virtually impossible to manage multiple tenancies with only one power supply and water supply, and potentially a breach of the Residential Tenancies Act. So that's a critical thing to check if you're buying multiple income properties, is that they have separate water meters and separate power connections and separate fibre connections. Fibre is perhaps not so much critical, as it doesn't cost that much to connect to fibre as it does for separate water or power. He goes on to ask, do all tenants apply and set up their own service connections, or is it better running it through private check meter and split the bill monthly? It's definitely better if everybody has their own separate connection. Makes it much easier for you as landlord, but far less hassle.
Well, you want to manage as less as you can. Those things should be self-running. You shouldn't be getting involved with those things. Otherwise, you start pulling your hair out.
Yeah, and if you've got multiple income properties and they aren't on separate connections, then they're probably unconsented.
Yes.
Not correctly consented as multiple properties.
Sorry, Ted's laughing at me because he knows I've got no hair left at the back.
Yeah, he said full of it. I was like, when did he start managing?
I do get very upset sometimes, and then I start my hair just drops naturally. Yeah.
Dave says, but well, he says yes, but does that apply to all rentals as previously those brought after 21 were barred?
Yeah,
Oh, so this
everything.
is interest deductibility.
Deductibility. Everything. Dave, the rules change. From 1st of April, everything can get 80% deductible.
Mhm.
So you're fine.
And then a year later, all your
100%.
interest expenses deductible, isn't it?
Yeah, absolutely.
Michael asks, it's a great presentation. Congratulations on your successes. I wanted to ask what strategy you would recommend to someone who currently lives and works overseas, but is a New Zealand citizen, and wants to buy an investment property in New Zealand with approximately 500,000 in cash. Where and what should I buy?
So if I was you, Michael, I mean, depending on all your earnings and things like that, if you've got 500,000 away, what I'd be aiming is basically going out of Auckland at the moment. The reason I say go out of Auckland is because the rent out of Auckland is similar to Auckland. You know, so places like Gisborne, you're renting 3-4 bedroom houses for $700 to $800 per week. Again, you could just buy that, do it up nicely, or give it to a social housing provider. There's house shortages in Whangarei. There's house shortages in Apia, you know, in all these areas. And again, you could just tie a long-term lease with a social housing provider. The reason I'd say if you've only got 500 grand to bring into Auckland, that's your deposit. That's not even your renovation money. So if you buy something for 1.5 million, you have to put 33% deposit. All your cash is gone. You know, so I'm saying go out of Auckland and buy something, unless you can buy something in Auckland around 1.1, 1.2 million with double income. That would be a good property for you to buy. Dual income, and you can just rent it to a social housing provider. But you know, that's what I'll be recommending you to do. Then,
Yeah,
Maggie?
presumably Michael would be able to borrow to buy this property. He wouldn't be limited to a $500,000 property, or would he struggle to borrow?
Well, I think as overseas, well, if you're a New Zealand citizen working overseas, I think that overseas income might not be recognized by some of the banks. So then, or it could be recognized, they might actually put more deposit in, you know. So what we got to do, Michael, is put you in front of a banker. So while we're presenting, we can refer you to a banker, or maybe you can book in a meeting with us, and we'll just look at all your affairs. We'll probably need an hour with you, Michael, and then we can give you a good advice on what to do. And good on you for getting into properties. Best time to get into properties is now.
Yeah, because prices aren't very high at the moment.
Yeah.
And, well,
yeah, and the cost of new build is only going up. You know, we are building houses every day. We just can't believe how expensive it is now to build houses.
Yeah. And Chris Peterson would be able to advise as to what Michael's situation would be, being able to borrow with his overseas income. Right, Jason, what do you think about high yield apartments to increase cash flow, or is it better to stick to freestanding houses?
Well, what you got to do if you're buying apartments, you've got to be careful. There's body corporate. Also, you've got to check for liquor issues. Also, you've got to check with your banks if they'll allow you to buy an apartments. There's nothing wrong with buying apartments. You've got to make sure all those checks are done. You know, and suddenly you don't want your body corporate to double or triple because there's issues with the foyer or the lift or things like that, you know. So I personally prefer freestanding houses. The reason I prefer them, or double, obviously do a double income and I buy the whole thing out. I prefer them because I can rent them out easily and I can do social housing as well. Whereas I think apartments, you can't do social housing in some of the apartments.
It's quite a specialist area, isn't it? It's not one that I've ever ventured into. I just don't feel comfortable with the idea of not really having that much control.
Yes.
And as you say, the body corporate could potentially suddenly hugely increase the fees. For example, I've also had a friend who owned an apartment that she lived in, and it was quite a decent building, but then KO moved in and brought up a whole lot of apartments, and suddenly the nature of the occupants changed considerably and values diminished, and instead of being an apartment building of working people, it became an apartment half full of rat bags with all the social problems that come with that.
Yeah, and what happens with social housing? Well, if you put so many people together, it actually becomes rough, and you got to be careful because, you only need one person to be the redback and just changes the whole environment. Yeah. Not all of them are, they're pretty good to deal with.
Yeah. So you'd have to have good understanding of the body corporate and its history, and of the building to be comfortable that there were no issues with it.
Yeah, exactly.
Dave says, what income level do you need for banks to grant you a loan?
Well,
how much you want to borrow and how much the rental income is.
Exactly. And all of that. I mean, you can't buy a $3 million house with, $1,500 a week rent. Can't do that. So you gotta be very careful what you're buying. The best thing is, again, we can help you get a good mortgage broker that can help you answer all the questions and maybe look at putting an application in for you.
Because they would just a quick overview, and they take your work income from your job or wherever you might have income from. They add the proposed rental income to that, and then they assess that against your expenses, so your personal expenses, whatever other debt you might have, and the proposed loan repayments.
Exactly.
So it's quite a few factors that feed into it to give for an answer. Right, Lena asks, how do you check if a property is in a flood-prone area and therefore avoid buying? So that information is available on council GIS maps, and you can find those online. They can be a little tricky to use, so you're welcome to book in a meeting with us, and we can show you how the Auckland one works anyway. And once you understand how one works, you can usually find your way around others.
And also, when you do a property school, when you do a property school, we guide you through that. We teach you to identify that. Sorry, then go for it.
Yeah, no, exactly what I was going to say. So we have a course that goes through, that process.
Exactly.
And also, I find that the regional ones are harder to navigate than Auckland.
I found that as well too. Auckland's quite easy, but some of the others seem a bit clunky. It can be a little hard to find what you need. But you can always resort to ringing the council and asking.
Yeah, true.
Kelly says, we have a development, just received resource consent for 5-lot subdivision. Congratulations. Living in existing dwelling and looking to sell the 4 lots to free up cash to renovate the dwelling. What other arrangements should we be considering?
Well, you got to be careful here because firstly, you're saying it's a development sign. Then you're saying you've been living in the dwelling. So I presume this is your family home, and you're looking at you've got RC to subdivide and sell. So I think, Kelly, this is actually quite a complicated question because we have to look at Brightline, we have to look at rezoning as well. You could probably just need to be careful you do this properly because you could end up paying a lot of tax here if this is not done properly. So we probably would need to book you in with one of the tax consultants, and they are about 550 plus GST an hour. To be honest, they'll just look at this within an hour, they'll discuss it and write you some notes and tell you exactly where you sit in terms of tax position. What I'm trying to tell you, Kelly, is I don't want to openly tell you where you sit in terms of tax or how to minimize it. We probably just need to meet on one-to-one because this is a recorded seminar. So yeah, I suggest you book in a meeting with him, but that's a very complicated question. We can help you.
Possibly, Kelly, means other options for the property as well. So there would be alternative
living in existing and looking to sell the 4 lots.
Sorry, what I'm meaning is there could be alternative options to selling the lots.
Yes, exactly.
Depending on your financial capacity, you could build rental properties on those 4 lots and keep them, for example.
Yes. But
and
then
you could do that slowly over time. So
yes. But just selling them, you got to be careful because you can have Brightline kick in, depends when you bought it, or you can have the Rezoning Act apply to the property as well. Because the reason the property is increased in value is because of rezoning, so it could be taxable. So we just want to hold your hands here. It's quite technical. But we know the answer. So yeah.
Absolutely, yeah, it does get very complicated from a tax perspective. But I think it's worth also considering other things that you could do with this property other than selling all of the sections that you create.
Yeah.
Yes, because one thing you probably won't do is get land back at current prices once you've sold it. Linda says, what is the social housing pros and cons?
Well, the advantage of social housing is obviously the properties are managed. You can negotiate a reinstatement clause on the property. And if tenants cause damage, they can fix all their issues as well. The disadvantage is your neighbors get really annoyed if you've got a wrong social housing tenant in there, and that's happened to me a few times. So I ended up buying the neighbors out, right? And that's one of the disadvantages. Secondly, is the main one is the insurance. You have to make sure you get the right insurance cover. If you don't have the right insurance cover, you might not be covered. It's simple as that. So it's very important. Get a social housing tenant before you get it. You send the tenancy agreement to the insurance company, get their approval, or you might have to hunt for a new insurance company.
Ying asks, hi Salesh, hoping to seek your advice regarding a unit title property located in the Auckland CBD, which includes an accessory land area of 500 square metres. Could you provide some guidance on the best strategies to maximise returns on this land? Sounds like that might be more of a planning question.
Yeah, I think that's more of a planning question. And Ying, I suggest probably you book Maggie for an hour, Maggie, for you to have a good look at it. And then
I can certainly have an initial look, but to me, it's and then guiding on where to go.
And then guide where to go. Yeah, exactly.
All right. Adding a bedroom. Oh, does adding a bedroom require consent? How about relocating the kitchen?
Yes, 100%. You need a building consent. If you're relocating your kitchen, that's for insurance purposes as well. You definitely need a building consent there.
And I guess it's how you're adding the bedroom. If you're building an extension, then yes, definitely need a building consent. If you're creating a bedroom with an existing footprint by simply putting up a wall, that's generally something you can do without consent.
Yeah.
Depending if you're changing any windows.
Yeah.
Right. Peter says, have you ever bought a property with an existing bungalow house, about 120 square metres, and then later move the old house to subdivide the land with the intention to construct multiple new dwellings? The land area is about 1,000 square metres, and the property is located on a suburban street with a generally flat contour and typical access to power, water, sewage, etc. What would you do with the original house? What would it take to go into a JV for the development of the site?
That's a lot of questions there. I was trying to keep up with the questions.
Sorry. Yes, we will have done projects where the existing house is repositioned and then to free up the land to construct multiple dwellings. We'll have examples of those, so we can say yes to that. Or whether, or perhaps more commonly, past projects where the existing house has been removed altogether. But
I guess the main question is how to go through a JV for a development site. How is a development JV is come together?
Well, is that the main question? What would
then he asks what we would do with the original house. I think that would depend on the house, but presumably it's in tired condition. So then if you've repositioned it, well, you obviously need to reconnect to toilet services and do all the other reinstatement work, decks and steps and porches and parking spaces and all that stuff that's lost when you pick up and move a house, and potentially renovate. But depending on the actual house and the floor plan, there could be, you might take it a step further and not just refurbish it, but perhaps reconfigure the rooms inside, because you have to get a building consent to reposition it anyway. So there could be scope to rejig it inside and create more bedrooms, for example. And then he asks, what would it take to go into a joint venture for the development of the site?
Well, that depends who your joint venture partner is and what they're bringing in. Are they bringing money in, or they're bringing skills in, or what are they bringing in? So again, you need to find the JV partner first, and then we can help you with that.
Yeah, and then you tailor your joint venture agreement to the specific situation as to what each partner is bringing to the deal and what they're doing and what they're responsible for. Jay asks, can you join GRA if you have an accountant already?
Yeah, sure. So what you do, Jay, is you basically fill out our RFI form, and we'll get in touch with you and get you basically book you in, and then we can go through and see what we can do for you. Yes, you can. So we have clients who have their own accountants, but they use us for tax consulting purposes.
And of course, you can enroll in property school, development school, or buy the books.
Yeah.
If somebody else is your accountant.
Yeah, exactly.
Linda asks how to apply for property school. We'd go to gra.co.nz/ps-offer, and that takes you to the page with the special price. Abigail asks, what should I do to create a separate water meter power connection for a minor dwelling we're going to be building for rental income? Is it something that gets applied for with the building consent? Abigail, I'd check with the draftsperson or architect that's doing your plans and applying for building consent. They'd be able to inform you on how to do that, because the process will vary depending on your location. So that's probably the best thing to do. If you're in Auckland, then it's an application to Vector for a new connection to power, and including a new ICP number. And then, of course, you've got to get a new fibre connection, and a new water connection is applied for through Watercare. But whoever is preparing your building consent documentation and applying for building consent will probably the best person to start with to talk to. Anything to add there, guys?
No, spot on.
Can be a bit complicated and vary according to location. If you get stuck, you can always get in contact and we'll try and point you in the right direction. Sandra asks, are 1960s style brick flats, say 2x2, a desirable investment? These are often quite basic.
Well, remember, housing is rental stock is all about being basic. As long as you have healthy home standard, you're fine. But again, you're buying it for the right price. That's quite important. All of that. Yeah.
And brick's pretty good because you don't have to paint it. So often what they call brick and tile, but I prefer brick and long run roofing personally, is in demand as an investment property because there's no painting and fixing of weatherboards that are deteriorating. And you can make the inside look nice and pretty.
Yeah. Now, Maggie and Then, I've just got to leave. I've got some cleaners here and they want to come in. Are you guys okay to answer the rest of the questions?
Yep, we'll be able to. I think the only thing we'll get, was UBI and CBDC, which is the Universal Basic Income and Central Bank Digital Currency.
Oh,
yeah. So Dean asks, impact, if any, do you think universal basic incomes and central bank digital currencies will have as they roll out towards the end of this year?
Yeah. I to be honest, I don't get involved with that side of investing. So central bank digital currency, we've got no knowledge of that because we haven't been provided. Well, the only thing we know is debt to income ratio. They're looking at bringing that in. So basically, we're allowed to borrow 6 times your earnings or 7 times. But again, they haven't brought that in. They just talked about it.
Yeah, and there's no universal basic income coming in New Zealand.
No, definitely not happening here. First time we've heard of that. Sorry.
Okay.
But yeah, Salish, we should be able to cover the rest.
I'll see you guys later. Have a good night, guys.
Good night, Salish. Okay, that's one's done. Rex says, should properties in floodplains be avoided, or are there ways to make them successful investments?
Well, every property that we go through nowadays, in the past it's been assessors. Every homeowners are asking or buyers are looking at. Now, every open homes that I go through, and I'm hearing out what buyers are asking is, has the house been flooded? You know, but also insurance. Can you get insurance on that? And then if you can't get insurance, then you can't get a loan on it. But if it's been flooded, so therefore you can't buy it in the first place. But then also the floodplain's not going to change, is it?
No, and if anything, over time it could get worse. So even if you can get insurance now, you may not be able to get insurance
To
in the
cover for,
future. Mm,
or could be exemption for cover from floods.
mm, yeah,
Um,
um,
I personally stay away from it.
exactly. There's plenty of property that's not in a floodplain, so why make life difficult for yourself? Because you can imagine, even if you get insurance now and you can buy it, if that insurance is withdrawn in the future, say flooding gets worse because of climate change or something, then your properties become worthless or near worthless, and difficult, if not impossible, to do any building on, depending on the depth of the flooding. So I think overall just safer to stay away from. Sam says, hi, what percentage of rental income do the banks use for serviceability? I just talked about that with my bank the other day. I think it was 67%.
So scaled it down to 60% of the actual income you get.
67% was what I heard, but of course it'll vary from bank to bank. What's your bank saying, Than?
Yeah, around about the 65% is what they're saying. But then there's other lenders, non-bank lenders that will go higher. But you know, a mortgage broker will be the best once you identify what you want to buy and get your budget rolling. Then you could go up there and buy. You know, we'd look at second tier or main tier.
Yeah, so mortgage brokers, I understand, have access to loan calculators that are actually accurate. Apparently the ones that we can just access on bank websites don't give particularly good results. So, and of course a loan broker is free for you to talk to and for them to run the numbers through their calculators. So that would give you the best indication of what you might be able to borrow. Jay asks, best way to find deals with the equity discount? So I think he's asking what the best way is. Do you use property finders, as I seem to have no luck with Trade Me Real Estate, which has competition from other buyers, or they are unwilling to discount already under contract?
I mean, property finders are good because once they've established what your budget is, where you're in the market, they are actively looking for deals. You could also use buyer's agent, for example, where the agent goes out and look for a deal on your behalf. But relying on online is not the most effective way. You're scrolling through. I found in it is to build that relationship with the real estate agent. That had helped me get more in front of more deals that worth looking than just looking online. Because you go through, build that relationship, then eventually they know what you're looking for, because you probably go to 10 houses at first, none of them meet your criteria, and then they go, okay, now I know what you're looking for. And then once something comes up, they will present it to you. And keep in mind, when you're working with real estate agent, they also got hundreds of other people that they're working with. So one of the things what I used to do in the past is schedule a time during the week where I'll call that agent, put my name in front of them so that when a deal comes through, I just spoke to Fan yesterday, or I just spoke to them on Friday. That way they will, hopefully the first person they send to you is you.
And it can be a long process to find a good deal. I'm sure you consider many properties, potentially even each day, just to identify a few that are suitable. And then if there's an element of luck in actually getting that under contract or being able to purchase a good one. So it is
There's a lot of no before yes. Yes,
Mm.
definitely. I mean, if I wish it happens to every second property that I look, but not the case. Then we'd be all
Yeah.
rich.
So yes, there's a lot of donkey work to get the good deals. If it's not happening for you overnight, it doesn't happen like that for any of us. I think the thing is not to get discouraged, because you
Yes.
definitely don't get a deal if you give up.
It's when you stop, that's when the deal's going to go missing.
Michael says, what do you think about buying in Christchurch? There are many townhouses new and only a few years old for around 700,000. I'll say that that neither Than or I know very much about Christchurch, but Michael, if you'd like to email questions through about Christchurch through to Amy, so it's amyb@gra.co.nz, her email's up on the screen now, then I will pick that up tomorrow and check in with Matthew Gilligan, because he does do quite a lot of investing in Christchurch. So we'll find out what he thinks about that, and we can get back to you with a response. Generally speaking, though, if you're talking about townhouses, new or near new, they are probably going to be on a very small parcel of land. And when you're buying that type of thing, like a terrace type property, terraced dwelling in a development where perhaps there's been a 800-900 square metre section with one older dwelling on it that's been moved off, and they've built a number of new ones on there. You're talking about a tiny parcel of land, comparatively speaking, that you're buying, and there's more than likely no scope for further improvement. So there's no opportunity to create equity, certainly no scope opportunity to utilise the land for adding additional dwellings, subdividing, or adding a granny flat or whatever might work. So what you buy is what you get. And the only way to sort of give yourself a boost is if you're buying that well below market value, because there's probably nothing you can do to it to create equity.
And one more thing that I will look into add to it is, what is the cash flow, overall cash flow is going to look at if you're spending that much? What is the rental income? What is the outgoing, when you look at outgoing insurance rates, property management fees, everything, and then see what's left over, and does it cover itself, or how much you'll be having to top out of your pocket when you're on a principal and interest loan payment. But more importantly, look at your overall strategy. Are you just buying this? But that we could go in more details on 101, which we do with our clients.
Yeah. Right, so feel free to email us and we'll get Matthew's thoughts on Christchurch specifically. Now, Dean says, we saw a duplex in Pakuranga by Pac Plaza. Pack and Save, maybe, he means? Oh, Pakuranga Plaza.
Yeah.
This week, that clearly had caught on fire, and the neighbouring unit, being 1 or 2 metres away, had been damaged as a result. Is insurance disproportionately higher for duplexes? Any experience with that thing?
No, I mean, we built that one in Marlow Road, and no, I mean, they go through all the fire ratings and everything, the intercontinency wall. They don't, I mean, there's more elements to, like, having worked at insurance in the past, they look at I'm not an underwriter, but but they look at the overall pictures of the area, the zones, flooding, earthquake. Fire is something that outside the control, because insurance is not going to look at, they don't ask for the plans or anything. When you're insuring something, they're going to look at where the address is for residential, what area is the building construction was done, and they'll use those data to work out the premium that you pay for. So to answer that question, I don't think having a fire rating will impact as much from an insurance premium. But you can always go online, put in the address, and see what the premium is. Get a quote.
Exactly, or talk to an insurance broker and get some advice from them, which is certainly something you want to be doing before you commit to purchasing any investment property, is inquiring with an insurer or with an insurance broker that does house insurance, as to confirm that you can get adequate cover, or cover that you're happy with at a price that you're happy to pay. And these days you don't know until you ask about a specific property, generally speaking. So that's us. We managed to wrap up the questions without Salesh then. Well done, us.
No need, Salesh. No, just kidding. Hopefully he finds his way. So that's us for the night. And yes, if you have any questions in the future, just email Amy, and sign up for Property School, and all the best with your property investing.
Oh, wonderful.
Thank you.
Okay, that was fun. Thanks very much, Dan, and thanks everyone.
Have a good night, guys.
Good night.